Job numbers released both sides of the border. The Canadian economy surged far ahead of economists' predictions, adding 95,000 jobs in May. And job gains were dominated by the private sector, full-time employment, and by paid positions rather than self-employment. That's all good news there. And the unemployment rate actually dropped to 7.1%. Stateside, the American economy created 175,000 jobs, but unemployment actually rose slightly to 7.6%. Kash Pashootan is going to be joining us shortly on those. Samsung Electronics is being hit with a $12 billion loss in market value after a series of brokerage downgrades, underscoring the concern of slowing sales of its flagship smartphone, the Galaxy S4. And this bombshell comes after Samsung actually introduced two stripped-down versions of the S4. And that's worrying the experts that the tech giant is trading profits for sheer sales volume. As I say, with the job numbers out in the U.S. and in Canada this morning, our next guest is here to weigh in on the potential impact. Kash Pashootan is the Vice President and Portfolio Manager at Raymond James. And good to see you in person, Kash.
Yes, good to see you,
You're in Toronto for a few hours, kind of.
Yeah, in and out.
In and out. Okay, job numbers. Let's start with the American numbers because those are the key market drivers. 175,000, a little bit higher than expectations. What do you think?
Yeah, so given that we've had some good news for consecutive quarters now, the market's looking for that to continue. And so that's happened, which is a positive, and we beat expectations. So my expectations weren't that we were going to have a blockbuster number. We were looking for better than expected. We got that, and so we're happy. The
Federal Reserve down in the States has said that they're not going to move interest rates or quantitative easing until they get to 6.5%. We're sitting at 7.6%. We got some room to have a lot more happen in terms of quantitative easing, don't we?
We do, Pat. And the other factor is inflation in the U.S. is fairly low. So in terms of the catalyst or the need for interest rates to go up, there isn't really one at this point. But I think the point in terms of its impact on the market is that the Federal Reserve raising rates will not happen overnight. So we're still waiting for that to come.
Where do you play this, though? If quantitative easing is going to continue, that's where they buy bonds in the United States to kind of keep interest rates in check. Do you buy bonds then as a result of that, or do you look at the stock market to get any kind of leverage or growth?
Yeah, I think bond market investors need to be very careful right now because, as we know, bonds and interest rates have an inverse relationship. Interest rates have already started to rise, and we see that with the 10-year U.S. Treasury, and so that's something to consider. But in terms of quantitative easing, really the idea is that as the U.S. economy improves, the need to have the same amount of stimulus in the system is not as prevalent. And so the Fed has indicated that they will be reducing or extracting some of that stimulus as they have further conviction that the U.S. economy is improving. So today's numbers, I think, keep that message the same, and it's reasonable to expect that that extraction or that tapering of stimulus to start in the next 6 to 8 months.
Okay, now let's take a look at the Canadian numbers. Economists, we're only looking for, I wouldn't make up these numbers, 15,000 jobs, and you get 95,000 jobs. And these are quality jobs. They're paid jobs as opposed to, self-employed people doing their own thing.
Yes.
What are your thoughts on the Canadian economy?
I agree. I think the main point there is not only the number beating expectations, but also the fact that a large percentage of those jobs were full-time and not contract or seasonal. And so you have that factor to consider. But really, it was a surprise. As you mentioned, not many were expecting that. We saw a bulk of those jobs come in the retail sector as well as real estate, which was surprising given the slowdown.
And construction, too, was another area. In terms of the market response, we're so conditioned to see the American job numbers and what they'll have in a response, and the Dow Jones is responding positively. TSX doesn't care about Canadian job numbers, does it?
Not as much. It's a good point because the TSX is heavily comprised of commodities, and so we're more dependent on what the US and China are doing because they are the largest buyers of our natural resources. And then other than commodities, we have the Canadian bank. So really, those are the two main components, and so the Canadian economy has less to do with it, but certainly the job numbers today are positive because for an economy, a developed economy, about 70% of GDP growth comes from consumer spending. And so if we're hiring, those employees are more likely to spend, and that votes well for the economy.
So if people are ignoring the consumer in terms of the stock market response, is that an opportunity to move into, I don't know, Canadian retailers or Canadian banks?
Yeah, we're underweight Canadian banks right now, primarily because what you're seeing is that net interest margin, which is the difference between what they pay someone on their savings account and what they loan the money out for a mortgage. That spread is fairly tight because interest rates are low. Now that has been counterbalanced by the fact that the banks have been aggressively growing their loan book, and we see that with consumer debt continuing to go up. I think the Canadian consumer is getting closer to reaching their maximum debt capacity. So it's important to consider that the Canadian banks, I don't believe, will be able to grow their loan book at the same pace. And the result of that is we'll see that in the earnings.
Okay, Kash, so where do you put your money right now then if you're a Canadian investor? Do you look at the States? Do you look at emerging markets, China or Japan or something like that?
Yeah, the main thing is it depends on the risk profile and how long you're looking at investing. In terms of our approach at First Avenue Advisory, we are focused on an overweight in the U.S. for the equity exposure. So 3 years ago, we were primarily in Canada, whereas right now, 2/3 would be in the U.S., 1/3 in Canada, primarily because the U.S. still looks attractive. It's certainly run up here, and we do expect a bit of a softening or a bit of a correction, but the underlying fundamentals, Pat, still look good. You have 7 of the 10 sectors generating double-digit returns for where the market's returns are coming from. Debt to assets are the lowest they've been. Cash to assets are high. So the underlying fundamentals are healthy, but you want to manage risk and expect a bit of a correction here.
Okay, Kash, great to have you here in Toronto.
Great to be here.
Appreciate it.
Thanks.
Safe travels.
Thank you.
Kash Pashootan joined us here as he does on a regular basis.